In the previous module, we examined escrow and its essential role as the neutral facilitator of real estate transactions, ensuring that all contractual and legal obligations are satisfied before funds and documents are released. Building on that foundation, we now turn to another critical safeguard in real estate: the protection of ownership rights through title insurance. Title insurance serves as the final assurance that once a property is transferred, the new owner receives clear, undisputed, and insurable title. The concept of title and its importance. In real estate, the term title represents more than a piece of paper. It is the legal evidence of ownership. Title reflects the cumulative history of ownership transfers, liens, easements, judgments, and other recorded claims affecting a property. Before a property can be sold or mortgaged, its title must be confirmed as valid and marketable. This means there are no hidden defects, legal disputes, or encumbrances that would prevent a buyer or lender from acquiring clear ownership rights. In Arizona, a buyer or lender does not rely solely on the seller's assurances of ownership. Instead, they rely on a title insurance company, which conducts an extensive public record search to verify ownership and uncover any potential issues that could threaten the validity of title. The purpose of title insurance, therefore, is to protect both the buyer and the lender from financial loss arising from defects in title that existed prior to the purchase. How title insurance differs from other forms of insurance. Title insurance differs significantly from most other insurance products. Traditional insurance, such as homeowners or auto coverage, protects against future events that may occur after the policy takes effect. Title insurance, however, protects against past events, specifically undiscovered defects or errors that already exist in the property's recorded history, but may not be apparent until after closing. For example, a property may have an unreleased mortgage lien from a prior owner, a forged signature on an old deed, or an undisclosed heir who later claims ownership. These defects can cloud the buyer's title and create legal and financial problems. Once discovered, they could prevent the buyer from selling or refinancing the property. Title insurance ensures that the title company will either correct the issue or compensate the insured party for their loss. The title search and examination process. Before issuing a policy, the title insurance company conducts a title search, which is a thorough examination of public records related to the property. This process involves reviewing deeds, mortgages, judgments, tax liens, easements, restrictions, and court records. The goal is to identify any recorded encumbrances or irregularities in the chain of ownership. Once the examination is complete, the title company issues a preliminary title report or commitment for title insurance. This report lists the current owner, the legal description of the property, and any liens, encumbrances, or conditions that must be cleared before closing. It is not yet a policy, but a promise that the insurer will provide coverage once the transaction closes and any listed exceptions are resolved. For example, if the title commitment reveals an unpaid property tax lien, the escrow company will ensure that the lien is paid and released before closing. This coordination between the escrow and title divisions ensures that the buyer receives a clean and insurable title at recordation. Types of title. Insurance policies. Arizona real estate transactions typically involve two types of title insurance policies: the owner's policy and the lender's policy. The owner's policy protects the buyer's ownership rights in the property. It covers the insured against losses resulting from defects that existed prior to the policy's effective date, such as forged deeds, recording errors, or undisclosed heirs. For example, if a long-lost heir later asserts a legal claim to the property, the title company must defend the buyer in court and pay for any covered losses. The lender's policy protects the lender's financial interest in the property, ensuring that the mortgage has first lien priority and that no prior claims could challenge the lender's security. The lender's policy remains in effect until the loan is repaid, whereas the owner's policy continues for as long as the buyer or their heirs hold an ownership interest. Both policies are typically issued simultaneously at closing. And while the buyer or seller may negotiate who pays the premium, these costs are disclosed on the settlement statement in compliance with RESPA 12 U.S.C. P-NARFA 2601 ASEQ. There is no Arizona Revised Statute or Arizona Administrative Code provision that requires an escrow company to complete a HUD-1 settlement statement for each transaction. The HUD-1 requirement originated under federal law through the Real Estate Settlement Procedures Act, RESP, and its implementing Regulation X. But that requirement was largely eliminated in October 2015 when the TILA RESPA Integrated Disclosure (TRID) rule replaced the HUD-1 with the closing disclosure for most residential loan transactions. Today, the HUD-1 is used only in limited non-TRID transactions, such as cash sales, commercial deals, and reverse mortgages, as a matter of federal compliance practice rather than Arizona statutory mandate. Arizona law instead focuses on an escrow agent's duty to properly account for all receipts and disbursements, not on the use of any specific settlement statement form. And ARS, paragraph 20, 1561 at SEQ, statutory oversight and legal framework. Title insurance companies in Arizona are regulated by the Arizona Department of Insurance and Financial Institutions, DIFI, under ARS Title 20, Chapter 20, Article 4. DIFI oversees licensing, financial solvency, and rate approval to ensure that insurers remain capable of fulfilling their obligations to policyholders. Commissioner's rules also require that all title insurers act in accordance with principles of good faith, accuracy, and consumer transparency. Arizona law also requires that title insurance be issued only after a complete title examination, ensuring that coverage is based on verified records rather than assumptions. This statutory framework reflects the broader public policy goal of protecting property rights and maintaining confidence in the state's recording system. Arizona courts have supported the protective nature of title insurance through landmark cases such as Burkons versus Ticor Title Insurance Coiser of California, 1991, which established that title companies and escrow officers owe fiduciary duties to act honestly, disclose material facts, and follow written instructions. In Tucson Title Insurance Coor v. D'Ascoli, 1961, the Arizona Supreme Court further clarified that title insurance companies are responsible for the accuracy of their title reports and must indemnify insured parties for losses caused by defects they fail to identify. These cases emphasize the essential role title insurance plays in preserving fairness, reliability, and public trust in Arizona real estate transactions. Practical example: consider a situation in which a buyer purchases a property in Maricopa County, only to discover after closing that a prior owner's contractor had filed a mechanic's lien that was never released. The lien holder demands payment, and the buyer faces a potential lawsuit to quiet title. Because the buyer obtained an owner's policy of title insurance, the title company will step in to defend the buyer and cover the financial loss associated with resolving the lien. Without title insurance, the buyer would be solely responsible for the costs and legal complications arising from a problem they had no way to detect. Discussion: why is title insurance essential in real estate transactions? Answer: because it protects buyers and lenders from financial loss caused by defects, liens, or claims that existed before the transfer of ownership, ensuring that ownership rights are secure and marketable. How does title insurance differ from other types of insurance? Answer: title insurance protects against past defects and existing issues in the property's title, while most other insurance covers future events or losses that occur after the policy takes effect. What are the two main types of title insurance policies, and who do they protect? Answer: the owner's policy protects the buyer's ownership interest, while the lender's policy protects the lender's financial interest in the property. Review summary. Title insurance is one of the most critical protections in Arizona real estate transactions, ensuring that property ownership is legally valid and free from hidden defects. Unlike other forms of insurance, title insurance looks backward. It insures against prior events that could cloud ownership. Title insurers research and examine public records to identify potential risks and issue policies that safeguard both buyers and lenders against financial loss. Arizona's statutory framework, enforced by DFI and supported by court precedents such as Burkons v. Ticor Title and Tucson Title v. Diascali, ensures the accuracy, reliability, and integrity of the title insurance process. By securing a clear and insurable title, this system upholds the foundation of property ownership, public confidence, and legal protection that defines Arizona's real estate market.